All right, everybody, welcome back to another video here on the Dividend Doggo Show on YouTube. Welcome back, Pack. I'm bringing you into a weekly portfolio review. As you can see, we have shifted downwards again this week. We do have a little bit of cash on hand for buying power this week from dividends, mainly from AbbVie and Ally Bank. That's going to get redeployed this next week. And let's go ahead and take a look at the portfolio and see what changes were made and what happened this week in the market. So let's drop it down to the 1 week. We did earn about $100 in dividends, but you can see here the market has shifted downward a bunch. We're down about $17,000 this week. So that is pretty wild overall. As you can see, we have a little bit of a shift here with healthcare. That is mainly AbbVie and Johnson & Johnson. We'll take a look at that here real quick. As you can see, Johnson & Johnson was kind of flat for the week, but AbbVie was down about 1.6% for the week, which brings us down about $2,500. Not too concerned with that one. Utilities, that's Vistra and Duke. Vistra was down pretty significantly last week, but came back up pretty significantly on Thursday, but then came back down a little bit on Friday. So that is pretty wild, the roller coaster that Vistra goes on. Like, if you look at them on a month, this is just like going to Universal Studios here for the stock. Like, 71,000 down to 156 to all the way down to 151, all the way back up to 168, and that's all in the course of like 1 month. So I expect it to be pretty turbulent as money shifts around. Finance, we have Citigroup. I'm going to talk about this one in just a moment. A lot of people are going to be like, wow, where did this come from? Citigroup has been sold off pretty significantly. As you can see, the finance pie has shifted and changed around a little bit. We've added Citigroup to the pie. We've removed Hingham, and we are just kind of holding on to this. I think that there's a lot of value with Citigroup, and I'll come back to it in just a moment. I went ahead and shifted a bunch of stocks around this week. So let's look at consumer real quick. This is where you can see a large portion of the week's roller coaster. It was pretty much all downhill for the consumer pie all week long. We started up at 147, and we dropped down to 136. So Ultra was down about 3.6%, Coca-Cola down 7%, Home Depot down 2.99%, Costco down 16%, Lowe's down 4.8%, and this is the whopper here, Target down 29% for the week. Now, Target was one of those stocks that I had bought into relatively cheap. If you look at the cost basis, it's still trading up from where my cost basis is on the stock. So overall, the stock is still green when I look at it, but just barely. So overall, this is pretty wild. We did earn $41 in dividends from Target this week, but we have to look at this as a position that we may want to potentially be looking at for adding to, because this is trending back toward my cost basis. And I've said that I wanted to get a little bit more Target in the past. So this selling opportunity, is pretty wild. The earnings were bad, but they weren't that bad. I think this is a little bit of an overreaction. Again, with Costco, I also think that was a little bit of an overreaction. Costco has tons of money on hand. We'll actually take a look at these two in just a few moments here in Qualtrim and just kind of get a little overview of the stock just for funsies. But overall, consumer pie really hurting off of earnings. People are sharply selling out of positions on earnings calls. Let's look at Coma Money. Obviously, Coma Money holds a lot of those positions. So when they're down on the consumer side, I believe Coke and Target and I believe Home Depot as well, those are all in SCHD, as well as a few others in my portfolio. However, with all of them being down, this is down a little bit for SCHD. Even Berkshire Hathaway was hit a little bit this week. So all in all, this was a pretty rough week for the market. You'll notice that tech is gone, industrials are gone. So there weren't any real changes with BST or anything like that to the portfolio. I'm kind of holding that right now. That is down another 3%. So we are definitely in kind of a buy territory for that, in my opinion. But overall, let's take a look at the changes so you see where the money went for the week here. It's just wild, the roller coaster that this is on for the week. So let's take a look at the sells and the buys. So this is what I did. I shifted completely out of tech and industrials in this particular portfolio. There's a couple reasons I went ahead and I made this decision. I should not have rotated back into tech in this portfolio in December. That was a mistake. And the reason for that is because we are very tech heavy in our 401k portfolios. So, and those are still getting contributions. We've already hit the cap for the year on 401k contributions. So that is mainly the F.I.R.E 500, which is very tech heavy. So I went ahead and I rotated everything over. Now, some of these were a bit at a loss, obviously selling out of Apple. That has created a little bit of a buffer for taxes. So I am going to be doing kind of some shifts around in other positions that are still very, very up. So I am looking at AbbVie, debating on whether or not I want to transfer a little bit of that out and rotate that into something else that's either a higher yield right now or a little bit more diversification for the portfolio, because that is one of the largest single stock positions I have currently. So we sold out of Raytheon, about $2,000 position, not a huge position overall. Microsoft, we had just put back in about 20 some thousand into Microsoft in December, so this was down a little bit. Lockheed Martin was actually up pretty significantly, and I felt like taking those gains off the table while I could, because the losses here are gonna offset that for taxes. As far as Apple goes, I think Apple is a quality company. I think that it's going to last for a long time. However, we are pretty overweight on Apple overall, because I believe the F.I.R.E 500 has it at like 5%. We have several $100,000 in that one fund alone. Caterpillar, again, not a super high conviction play, a little bit beat up right now, but not really in a buy territory. So just kind of, these are stocks that I'm not necessarily going to want to have to spend time researching and keeping up with. Hingham, I was up on this stock pretty significantly for a while, but it came down to about my cost basis. So I went ahead and sold it. It's a very low yield dividend position. And Google, I had been putting the Google paychecks into Google, but we again are contributing to our 401k and have a pretty significant stake in Google when I was looking at things and kind of reassessing. So I'm gonna go pretty deep toward the positions that are going to be very high yielding, over 3% dividend yield, and try to really focus on building up that dividend income. If we do hit recession territory, where the stock market is still floundering, going down, I'm going to be able to redeploy those dividends and put them to work and buy more and more shares in these companies. So with this shift, I went from about $22,000 a year in dividend income to just over $24,500. So overall, that is a pretty hefty jump for the portfolio, and it really does kind of take off. Starting in August, we'll be getting these heftier payments into the portfolio and getting to redeploy that. So that is pretty wild. Now, the Citigroup, obviously, I just shifted over this, so this is not actually going to be paying out for May. So I was not in this stock on April 29th, so that means I will not get this beautiful dividend payment of $722. That is a pretty wild shift to go to, and I know that some of you are probably questioning, like, what am I thinking there with that? But this significantly raised the overall dividend yield of the portfolio by shifting over into Citigroup and more into JPMorgan. Both of these companies have some traits that I'm going to go over and look at here in Qualtrim, but I'm going to go ahead and take a look at that now. So let's look real quickly here at their overall kind of balances. They were hit pretty significantly quarterly earnings, which did bring the stock down pretty significantly here. And we're looking at a price to book of 0.5 for this particular stock, price to sales of 1.3. The PE trailing 12 months is 5.8, and that is going to go up a little bit to 7.3 as costs are going to go up a bit. Their market cap is just under $100 billion. They have pretty sizable balance sheet as far as cash goes, but they do also have a pretty hefty debt load as well. They are paying out a 4% dividend. It's just over 4% with today's prices, with a payout ratio around 24%. Now, overall, these metrics are pretty good. The things to be concerned with are the margins going up and the growth. Overall, if this continues to kind of falter, then this could be kind of a danger point for the stock overall. However, they're in a pretty significantly solid position, having $100 billion worth of cash right now. This could float this company for quite a while. As you can see, I mean, their market cap is $96 billion. That doesn't, it tells you that something is potentially awry there when they have about that much cash on hand. So if we look at the cash on hand, it was up near $500 billion in 2018 and then dipped pretty significantly. And then it's kind of been on the rise again and slowly going down. One thing that has been interesting is they've raised the dividend, but then they've held the dividend very steadily at 51 cents, which is a pretty significant payout. 4% is no joke. Their debt load has been pretty flat, and then they've recently started trending it down, which is great to see. They've trended it down about, $1.1 billion in just from December to March of 2022. So their shares outstanding, this is the one really big attraction point for me, is that from 2017 they have been consistently buying back their shares. They started at 2.7 billion shares outstanding, and now we're at 1.9 billion shares outstanding. That is a really big drop in shares outstanding in 5 years, and that I really do like. You can see that EPS has been pretty consistent with high points in mid 2021, and then it's kind of dipping back down right now in 2022. We're going to see if this stays the same or if it continues to go up a little bit. I expect that there will be a little bit of a fluctuation as far as EPS goes. And overall, main reasons for buying into the stock: their plan, buying shares back, absolutely phenomenal plan. They are on a debt reduction path right now. They have enough cash to float all of their debt payments for many, many years, if not pay out all their debt outright and still be operational for many years. So I expect them to be relatively recession proof without any government assistance and changes there. So I think they'll be absolutely fine. Now, the other stock that I put a lot of the money into is JPMorgan. JPMorgan is, in my opinion, they have an even better balance sheet. They do pay a little bit of a lower dividend, and I'm going to be looking to continue to build this position up. The one thing that you see that's relatively consistent here is there wasn't much appeal to paying off debt over the past year and a half, 2 years, because interest rates were so low on that debt that you could turn the money around and turn a profit on it pretty easily. Now, JP Morgan's cash flow is kind of all over the place. I would like to see this get a little bit more consistent, but I do think we're in for potentially a couple more negative quarters. But when you're holding $754 billion in cash, you can afford to have these swings right now, and you will outlast any recession period that we are going to see. Even if it lasted half a decade, this company would still be absolutely fine. They have been pretty consistently raising the dividend over the past few years from about 50 cents to just over $1. They're holding more cash now than basically ever in the company's history, I believe. You see a very consistent trend of shares outstanding going down overall. We did come up a little bit from the end of last year to this year, but overall I think they will end because they have a plan to buy back, I believe it's like $90 billion worth of buybacks. Or is it 90? Not 90, sorry, that was Apple. I believe it's like 20 or something like that. But overall, I think that we're going to see the shares outstanding continue to decrease, which makes EPS go higher. Overall, their net income has been relatively solid. Even into the last quarter, they still made about $8 billion there. So overall, they pay out that 3.41% dividend, and getting a 3.5% dividend off of a bank stock that is this high quality is just astronomically amazing. Like, this is another one of those that I'm going to be watching as it keeps going down. It is below my cost basis, so I was lowering my cost basis by buying this, and I'm going to continue to keep buying this stock going forward. Now, I do want to take a look here at Target. Target real quick, because that is another one that I want to potentially look at. So this is annual, this is quarterly for Target. Target has been continuing this thing that I love in my stocks, which is shares outstanding reduction. We're at 4.71 right now. Just 5 years ago it was 550 million. That's a pretty significant drop. Overall, their free cash flow is still pretty solid over the past few years. Even through the pandemic, we see these massive spikes. I do expect this number to drop down pretty significantly once the new numbers are kicking in for the most recent report. Overall, though, they are sitting pretty. They have just a little bit of debt. They have about $5 billion in cash, $11 billion in debt. I do think they'll be able to sustain through any type of little recession that we receive here. Their dividend trend is on the upwards. I absolutely love that. Overall, I think that they're poised to do very, very well. And I think that taking a look and buying them, if you're interested in them, is absolutely a pretty solid idea looking at the metrics overall. Now, they could have a couple of years that are down, and you might be able to pick them up at even cheaper prices, which is kind of what my plan is. My plan would be to just dollar cost average a little bit of a time, picking up a share here and there and expanding on the position from there. And then the big whoppers here, like Costco, Costco coming down is absolutely phenomenal. It is still a very expensive stock. Their free cash flow is down just a little bit right now. Their dividend, you see they paid that special dividend in 2021, or sorry, that was the end of 2020, going into 2021. And then we haven't seen another special dividend. They're just kind of holding cash balance. It's a net positive overall. Their shares outstanding have been going up a little bit. So that's something that I don't necessarily like, but it is, they're just small increments. This went down this most recent quarter, which is a good sign. But overall, when we look at this, this is one of those that I'm going to hold off a little bit for a little bit on and see kind of where it goes. If they continue this downtrend, I'd be happy to add to them somewhere in the 300s. That would be pretty solid to me, to continue to hold this for a very long period. So that's what I'm going to do with my current position. I'm just going to hold on to it. I bought into Ally Bank just a few months ago, and they've done nothing but go down in craters since I bought them at about $50 a share, and now we're sitting in the high 30s. Free cash flow is going down a little bit here, so I'm going to be really curious to see if the, I knew that this was pretty rough the end of 2021. So we're going to see kind of how auto loans go and things like that. If auto loans are going to see the high spiked interest rates, like the housing market is currently seeing, we're back up into the 5% interest range. So as the Fed raises interest rates to combat inflation, we're going to see kind of what happens with this company. I'm going to add more to the core positions that I really like right now, like Citi and JPMorgan, over adding a little bit more to Ally. But adding to Ally and getting an over 3% yield right now is pretty phenomenal, and I'm definitely going to be keeping that on my radar because I am lowering my cost basis on the stock by adding to it. They had a pretty solid track record of doing that thing that I love, of reducing the shares outstanding over the past 5 years. So their shares outstanding are relatively small overall, but this is a much smaller bank than JP Morgan, so their safety net is very small in my opinion. So it's one of those that I want to hold for diversity's sake, but I did invest heavily into it, and it's going to take quite a bit to recover over time. So that's kind of where we're at with the portfolio right now. If there are any questions, I would love to hear them down in the comments below. Do you have a favorite bank that you're investing in? What do you think of Citi? What do you think of JP Morgan? I have used JP Morgan in the past. I've also used Ally. I've not used Citi since I was in college. I believe I had a Citi credit card, but I have not used them in quite some time. So overall, what do you think of the banks, the banking sector, it being significantly beat up right now? What do you think of the trend with Target and Costco, Walmart, all of them just getting absolutely hammered on earnings? I know that these companies are going to, keep selling product. Most of them, I think, will weather the recession, if we do end up in a full-blown recession, just fine. And we'll kind of see where things go from there. I'm repositioning my money specifically in this portfolio right now to make sure that it is creating a bunch of passive income to reinvest into the portfolio and go from there. So overall, that is kind of where we're standing for the week. I hope that all of you had a fantastic week. I'm looking forward to this weekend. We have a couple days of sunshine going on here in the Seattle area, so I am looking forward to getting outside. I've got to do some yard work this weekend. I appreciate every single one of you, all of the likes, comments, the subscriptions, all the new people joining the channel. The goal of this portfolio is to make $80,000 a year in dividend income. Thank you very much for watching, and I will be back at you with another video here very soon.